Good afternoon. My name is Thompson Adebo.
And my name is Hosein, and today we're going to be presenting on American Airlines Group and giving a financial analysis of them.
But before we get into the nitty gritty, I just want to give an overview of what we will be covering. We're going to start off with American Airlines background, then we'll be going into performance analysis, then we'll be comparing American Airlines to Southwest Airlines, then we'll give you SWOT analysis, and then of course we'll have our conclusion.
Right, now into the background.
American Airlines Group was formed on December 9, 2013, and the company came as a result of a merger between AMR Corporation and U.S. Airways. And AMR Corporation filed for Chapter 11 bankruptcy on November 9, 2011. And AMR and different companies were offering bids to the company, and they decided to go with U.S. Airways. They felt that that was the best route to take, and so they ended up combining with them and forming American Airlines Group.
Right, just to add on to what Thompson was saying, when the bankruptcy was filed in 2011, AMR started laying off workers. They started cutting their flights, and they were just kind of, trying to figure out a way to get this cost debt structure to work out. Then they decided, maybe a merger would help us get where we need to be. And U.S. Airways said they supported this decision and that they would be willing to merge. When the merger took place, they mutually agreed that they would hold on to the American Airlines name, they would hold on to their logos, they would hold on to basically their identity, and U.S. Airways was just going to stand as the group that got them out of the bankruptcy and formed together to make American Airlines Group and one of the world's largest airlines.
Now for the performance analysis, we will be covering the income from continuing operations. Then we'll be going into the significant increases in assets and liabilities. And then finally, we'll be talking about the reissuance of common stock, which we feel is very important.
Right, and we picked these three things because they were so significant, and they had such large increases from the year after year. But it is important to note that our numbers are a little bit skewed because we have American Airlines only existing from December 9, 2013 till present, while our 10K report that we analyzed was 2013, which included 23 days of American Airlines and the rest of it being AMR Corporation. So in what we can see from 2012, they had income from continuing operations at 148 million. In 2013, we saw it almost at 1.4 billion, at 845% increase. That is a huge increase, and we can account it to the 23 days of American Airlines being in existence. We can account it to they already had one full year of bankruptcy in 2012 as AMR, and in 2013 they were able to learn from their mistakes. They were able to implement some new plans, try to get things going. Or we can just say, the merger between AMR and U.S. Airways that formed American Airlines, really took off, and they really saw a lot of great things happening and being created for the company. The next thing we want to talk about is the huge increase in assets and liabilities. To start off with cash, we always say cash is king, cash is power. American Airlines increased their cash by 137%. Just to note, AMR Corporation went into bankruptcy with $4 billion in cash. So the majority of this cash came from U.S. Airways and what American Airlines acquired in the merger. Secondly, the assets increased greatly from jets, from inventory including fuel, spare parts, and flight equipment, and they were able to acquire all of this from U.S. Airways in the merger, and they saw it increase by 80%. However, with assets comes liabilities, and yes, we can note that AMR went into bankruptcy because of the liabilities, because of all so much debt, but U.S. Airways had debt also, and they acquired that in the merger, and they saw their total liabilities increase by 80%. However, with the plan of reorganization going into effect with this new large company giving air travel, they would be able to, overcome the liabilities, use their assets and their cash in a more positive way, because obviously it wasn't being used in an effective manner, and that's what drove them to bankruptcy. But now they were able to use the assets acquired and really get off on the right foot. Lastly, we want to talk about the reissuance of common stock. When AMR Corporation filed for bankruptcy, they pulled their stock from the New York Stock Exchange. And we talked about, not paying dividends being a bad thing, but I guess pulling stock would be 100 million times worse. And we saw equity for AMR Corporation in 2012 at negative 7 billion. In 2013, it was still negative, and for that reason we weren't able to calculate our equity ratios, but it was at negative 2 billion. And so that was a $5 billion increase just from the reissuance of AAG stock, American Airlines Group stock, and being able to put that income from financing from the stocks into the corporation and really get afloat and bring in more revenue into the company. Next, we're going to go into a comparison to Southwest Airlines. Again, the analysis that we just talked about was really, I guess, the majority of AMR Corporation, but that last 23 days of American Airlines Group, we already saw great things, and now we're going to compare that to what Southwest Airlines did in 2013.
Now, just a little overview of the comparison between American and Southwest Airlines. We did see that Southwest Airlines is a stronger company than American Airlines right now, and we saw significant differences in areas such as the net income and the liabilities and the stockholders' equity. Now, please keep in mind that, as Tariq was saying, American Airlines Group is a new company. So, although Southwest has better numbers right now, we do feel that given a little bit of time, a few years, American Airlines Group can actually overtake Southwest Airlines in the marketplace. But Tariq is going to go into more detail about the differences between the two companies.
Right, and exactly as Thompson was saying, this new company, it suffered a lot. It had merger expenses, it had other expenses, special expenses, things they, just popped up because of this merger. And really, if we compared this to any airlines, the other airline would always be the more favorable one. But we have to kind of take into account what they were trying to do, what position they were in 2013, and what this merger has done for them. So as we compare, we saw that the revenue was kind of the same. Their cost of goods, which includes fuel and salaries for the pilots and the employees, were kind of the same. American Airlines again is bigger than Southwest, so they had more. But their income from continuing operations was about the same. We had American Airlines at 1.4 billion, and we had Southwest at 1.278. So they were pretty close. What happens next is net income. We see American Airlines go into a negative $1.8 billion in income, net income, where Southwest Airlines had 745 million in the positive. So that number alone, again, it is skewed because of the merger expenses that American Airlines faced, but you can just look at Southwest Airlines and see how stable they are. You can look at their assets and their liabilities, and it's really low numbers. It's been year over year over year, it's been manageable, and it's been kind of the same. Their inventory only increased by like 2 million, and then there's been sustaining and really going about their business in a positive and profitable manner. Whereas American Airlines are, they hit rock bottom. They're trying to build themselves back up, and it's a lot of struggles going on with them right now. In addition, we want to look at their short-term investments. Again, American Airlines has short-term investments of 8 billion, but that's a lot from the increase from the merger. But the last number here is the equity and the cash from continuing operations. Equity again is negative 2 billion for AMR, for American Airlines, and positive 7 billion for Southwest Airlines. Again, it's because of the reissuance of stock. It's now coming up, and they're going to be able to get that deposit, hopefully, I think, in the next year or so. And the last thing, the income from continuing operations. American Airlines had it at 675 million. Southwest Airlines, they were at over $2 billion. So Southwest Airlines knows what they're doing a great job of it. But again, they didn't have to worry about mergers and acquisitions and management being changed, and they didn't have to worry about all that. So again, American Airlines looks like the worst company here, but Southwest Airlines is doing this phenomenal job. But as American Airlines can weather the storm and move into a more profitable manner, we can see them really being a powerhouse in the airline industry. Now Thompson is going to go into a SWOT analysis and talk about the strengths, weaknesses, threats, and opportunities.
Okay, so for the SWOT analysis, the strength, and we keep talking about this over and over again, is American Airlines' reissuance of stock. And we feel like this is a strength for the company because Now they are able to have a cash flow from financing, and they're able to pay out dividends, which are very important. And now investors can help fund the company, which also lessens the amount of loans that they have to take out, because they have had to take out a lot of loans due to the merger. But now that they have people investing in the company, they can use money from their investors as opposed to going out and seeking the money from another party. So the reissuance of stock has really, really helped American Airlines. Now, a weakness of the company is the management, and this is because of the merger. The merger took two different companies, AMR Corporation and US Airways, and it just placed the higher power together, so the executive level, the management, and it just trickles down all the way to the pilots and the flight attendants, etc. So that's two different company cultures, and they're trying to combine it as one. So we can see this being an issue within the company, just because American Airlines is probably trying to find its identity and its vision for not only to project to the outside world, but also for the people working within the companies as well. So there can be a clash of cultures, and we see that being an issue for their company. Now, an opportunity for American Airlines is its increase in capacity. As Tariq said earlier, they did acquire jets from their merger. So with the new aircraft that American Airlines has, we see them being able to accommodate for more flyers, and they can now go to more destinations, and which can help them increase their overall stance in the market. Now, for their threat, although they are increasing in size, we do see that increase as a threat as well. Due to the fact that although American Airlines is a brand new company, like we have been saying, they already are one of three companies that have about a quarter of the market share. So this rapid growth, it can be seen as a good thing right now, but if they were to grow too much in the future, we could see them becoming a monopoly, and then of course, due to government regulation, it would break up the company, which is not a good thing. But that is the SWOT analysis of American Airlines, and now we're going to go into the conclusion.
All right, and to conclude, we had a couple of questions we wanted to ask, but because we had a ghost audience, we're not going to get much of a response, so we're just going to go straight into the answers. We kind of wanted to, it was in our best, it was really good to us that American Airlines filed their 2014 10K just as we're completing the project. So we're able to take a peek in and see how the merger worked, how the acquisitions worked, how everything was going. And we saw their net income increase from 26 billion in 2012 to 42 billion in 2014. So they increased, in 2014, that's right. So they increased by over 59%, 59.5% in their operating revenue. Next, their net income went from a negative 1.8 billion straight up to a positive 2.882 billion. So that was a 257% increase. That is a huge increase, and this is just one full year of operating as American Airlines Group. There is no doubt that they're going to continue to grow once they go through the growing pains and they become more mature and they get into the business more rapidly. They're going to grow astronomically. We thought, they're going to grow maybe in the 1 billion, maybe 1.2, 1.5, but then they bust out with 2.882 billion, and that was just a ridiculous number, and we just expect great things from them in the future. And the last thing we wanted to kind of decide, is American Airlines Group a growing firm, a sustaining firm, or a maturing firm? And even though they are growing, because they are new, they're only a year or two old, they are growing, but really they're sustaining because they have the identity of a new company, the name of a new company, but they've had a long, lots of years of being in the industry, knowing what it takes to be successful. And really right now they're not maturing because they still have some issues to work out, they still have some high debt to work out. I think they're sustaining, and I think Thompson agrees that they're also sustaining. To wrap this up.
Yes, I do agree that they're a sustaining company. They're new. They started off strong, but they're not as self-sufficient as you would see with the maturing company. But given a little bit of time, they will be able to move into that category in no time. I truly believe that, and I agree. with Tariq.
Right. We thank you. It was a pleasure doing this analysis on American Airlines Group, and we hope you enjoyed it. Thank you.
Have a nice day.